Why do you want to get away from the stock market model? Well, the stock market model, when it was set up, my understanding is it was a way for somebody who had built a business and their kids didn't want to take it over, that they could get out of that business and have money for retirement. But that is not how publicly traded companies are run today. That's not the motivation today. And so maybe there's some out there that still have that motivation. But the way that a lot of the abuses we see in our society today can be linked to publicly traded companies and the whole model and the whole system of doing stock. Because the biggest, typically the biggest expense that a business has is labor. It's usually, 50% at least of their expenses. And so CEOs are rewarded by managing to the quarter. They're not rewarded by managing a company for a 20-year outcome. That's not how they're incentivized. And so if you say, well, what does that mean? It means the CEO is going to lay off thousands of people if it helps him make the quarter. And you say, well, that hurts the company in the long run because, any creative work they were doing, any products they had in the pipeline, anything that just all stops or it dies or it gets shortchanged or, pace of development slows. I agree. Absolutely the case. It's a terrible way to manage a company to do it quarter by quarter. But that's the system we've relied on for quite a while now. And I think there's better ways. I think that we could do that different, and it would be a lot better for employees and their families. And I think it would be healthier for the company. And I think it'd be healthier for the consumer too, because today you just hear this constantly. It seems people are just fed up with cheap junk. They're just fed up with the products they're getting. And again, if you don't care about, we've got to develop long-term relationships with our customers because we're managing for the long term. We want this company to be around 100 years from now, and we have plans that are scheduled out 25 years from now. You have a longer window and you treat your customers better. You're trying to build loyalty. But if you don't care about any of that, you just got to manage to the quarter, then you spit out cheap junk. You try to make it as cheap as you can. And it burns the customer too. So I think that employees, their families, the customers, the businesses are all healthier if we can get away from the current way of doing publicly traded companies. I think it's just a horrible problem that we have all kinds of horrible problems because of doing it that way. And I can elaborate on that a bit. Let's say you're going to do a startup and you want to raise money. You've got an idea, you've got a concept, and you say, let's raise some money to do that. You're going to do multiple rounds of fundraising through venture capital before you ever get to an IPO. You're going to do A, B, C, D, E, F. You're going to have 5, 6 rounds, whatever. And, you're going to have seed capital first and then multiple rounds. And you've got to demonstrate that you're making progress. And you've got to demonstrate, hey, I started out with this widget and it did a little bit, and then I took your money and now it does more, and I was able to, get some customers, and if you give me more money still, then I'll get even more customers. And you have to constantly be putting your effort as a founder into raising money. It's time consuming, it's tiring, it's exhausting. And it's kind of wasteful because you really want the founders who've got the idea to just be working on the idea. Like, hey, let's get stuff done. And I think that's another problem with the way that we do publicly traded companies. And, you're saying, okay, each time you do another round, maybe your first round investor, he's cashing out. Maybe he stays with you the whole way. But the goal is that you're going to get to an initial public offering on the stock market exchange. Okay, pick one. Anyway, you're going to get to an exchange eventually. And then all these rounds of funding, pre-rounds of funding you did, whatever, those investors are looking to cash out. Now, some of them might stay with your company, but not necessarily all of them. Now, the other thing is when people buy into a company through stock purchases, say it's a Vanguard, State Street, BlackRock, whatever, they buy into your company, those three combined might only own 10% of your company. But that might be enough of a controlling interest that they can tell you what to do. And the people that are investing in that or buying that stock doesn't necessarily mean that they know how best to run that company. They feel that, they should have somebody on the board because they own a percentage of the company and that way they're protecting their investment. But unless they know what in the world they're doing, they probably aren't protecting their investment, especially in today's world if it's a technical product. If it's a tech company of some sort, if they have extra money sitting around that they're trying to figure out where to deploy, that tells me that they don't have a good idea. They see your idea and they recognize it as a good idea, and so they're willing to push money your way. But if they were so in tune with what needed to happen, they'd have already done it. They'd have already done it themselves. So to argue that they're really, protecting their money, I'm not so sure that argument holds as well today. Typically today, especially if it's a tech company, you want a tech guy or a hands-on guy. You want a technician, a workman, a tradesman, an engineer, maybe a doctor. Depends on what the kind of tech you're talking about and how complex it is. But you kind of want somebody like that who really knows the ins and outs of that technology to be running your company. Why? Because it takes years to come up to speed on those types of skills. And in the fast-paced environment in which we find ourselves, the fast-paced business environment, you've got to be able to size things up pretty quickly and make decisions pretty quickly. Do we need to merge with that company? Do we need to buy that company? Do we need to, what's the latest research papers that have come out on whatever? Can we integrate that into what we're doing? Does that help us get ahead? Because you have competitors, you have people in the market you're competing with. And so you've got to be able to come up to speed pretty quickly on that. So in the past, if you'd maybe had an accountant running the company, now that really should be more of a support role. Is it needed? Absolutely, it's needed. But I think, can an accountant learn engineering? Sure, they can, but it's going to take time. It's going to take time to do that. So you need a lawyer for, risk mitigation. You need your accountant. You need your lawyer to help you come up with the business deals. You need those things, but they really probably should be more in support roles. So if you have a bunch of finance guys sitting on your board representing companies that own stock in your company, they're not necessarily really protecting their investment the way maybe traditionally they would have been. And that's another reason to argue against our stock market way of doing things. There's derisive names for those people, but I'm not saying they have no value. They do, or they can, but it's not as clear as it maybe was 50 years ago.